So to start our presentation for today on unlocking China investment, I wanted to provide at least everybody an understanding of who we are at Global PMI Partners hosting the event. We're a set of international experts that provide pre and post-merger integration advisory and execution services. And my name is Stefan Hoffmeyer. I'll be your host today. I'm a partner at Global PMI Partners out of the San Francisco Bay Area. So moving on with Matthew Wisla. Matthew co-founded the Marketing, Advertising, and Public Relations Forum for the American Chamber of Commerce, AmCham China, in Beijing. Matthew is former Vice President of Communications for AmCham China and worked in the United States and Beijing for a leading global communications consultancy, Flashman Hillard. Welcome, Matthew.
Thanks, Stefan. It's good to be here. For M&A in 2014, it's really like a skyrocket kind of screaming up into the night. You may have seen in the Wall Street Journal's reporting just yesterday that American companies have agreed to or proposed $638 billion in in M&As so far this year. Likewise, Chinese foreign direct investment, and that's our topic for today, is also setting records. And Chinese FDI is really of global economic importance, although right now, no economist or finance minister's crystal ball is going to be able to tell us what the implications are going to be. But we know that the trends that are emerging are already significant. The consensus is that the implications are going to be massive. So, right now, it's kind of like watching a fireworks display where the rocket is going up, and we just don't know how big the burst is going to be. As Stefan said, while I was in China for 9 years and just returned over the summer, my responsibilities included maintaining a nuanced understanding of the business landscape in China, both for my clients when I was working with Fortune 500 companies with Flashman Hillard, and also for the members of the American Chamber of Commerce when I was working as the communications person there. We also work with a lot of Chinese companies on the consultancy side, and what you might not expect is for the Chamber of Commerce, actually more than 50% of our members are Chinese. So we worked with Chinese companies and Chinese business leaders on many fronts in China. So looking at the topics for today, here's how we'll approach it. First, we'll do an overview of Chinese foreign direct investment generally. Then kind of examine the business landscape in China. Thirdly, look at the Chinese business people and how they view the West to get an understanding of how to work with them in M&A deals. And then finally, finish with observations on how to work with Chinese companies, Chinese investors. Some of you may be familiar with Stephen Roach. In the bulk of his 30-year career with Morgan Stanley, he was the bank's global economist for the whole world. So he was the global economist for Morgan Stanley for more than 30 years, and he was also the chairman of Morgan Stanley Asia for a significant amount of time. Currently, he is the Global Affairs Senior Fellow at Yale. Here he is at the World Economic Forum at the summer session in the Chinese city of Tianjin in 2012. But last month, interestingly, he spoke at the Asia Society, and what he said was when he moved to Asia and to China, the reason that he did that was he realized how important China was becoming, and that he and his best economists, and from what he could tell, most economists in the world, couldn't understand what was going on in China. So he realized that he needed to be there in order to understand it. And a lot of us know, it's common knowledge that China's big, it's fast moving, but what really isn't completely appreciated is how idiosyncratic China is. In order to gain insights into sort of understanding what's happening in China, you really need to know more than just the results of what's happening. You need to understand what the levers are that's driving the results forward. In other words, it requires understanding China from the Chinese perspective. And the way that Roach put it was that looking at China through the West's tools for analyzing itself is totally wrong. We just don't get it. So what you have to do is understand China from the Chinese perspective. And here's an example. So earlier this year, China announced that its GDP target for 2014 was going to be a growth rate of 7.5%. The first quarter results came out, and it came in at 7.4%, and there was a lot of discussion in the West, a lot of talking heads discussing what that 7.4% means. It's not that China isn't focused on its GDP and they don't pay attention to it, but actually, Chinese economists and the Chinese government are focusing on rebalancing the government and rebalancing the economy in order to create a stable trajectory for economic growth in the future. So while in the West, the GDP is very important, in China, it's less important, but here we were spending a lot of time focusing on what 1/10 of a percentage point difference in the Chinese GDP target would mean. So there's a disconnect between people who choose or who want to sort of describe China through the Western perspective and the other side looking at it from the Chinese perspective. And the thing is that right now, with so much changing in China, it's really important, if you want to understand China, to get a grasp of it from what the movers and shakers in China are trying to accomplish, not just on the obvious results that we see in economic reporting and other things. So let's talk about Chinese foreign direct investment more specifically. Um, the trajectory is unmistakable. So in 2008, just a few years ago, minimal capital outflow from China, and last year it was over 780 billion in investment. And when you think about how much money has flowed into China over the years, how much foreign direct investment has been poured into that country, in just a few years from now, perhaps in 2018, China will continue to absorb a lot of FDI into the country, but is expected to be, by that time, a global net investor. So more investment going out than in. So we can anticipate competition then from Chinese companies in a variety of Western markets around the world as they come out. So, today our headlines, some of our headlines are dominated by General Electric's bid for Alstom in Europe. And in the future, GE and other American and European and Western companies could be competing for M&A deals with Chinese companies outside of China. So this is from the Heritage Foundation. Derek Scissors is the fellow there that does a lot of great work on outbound Chinese investment at Heritage. And these numbers were updated as of July 2013. And you can see a pretty interesting spread of investment around the world. You can identify areas that are resource rich, where investments are going in for extractable resources, such as obviously Australia with mining, the Arab world, Russia and Iran. But you also see significant investments in the modern world, in Europe, North America, and the U.S. So extractive resources like energy and minerals, and also investments in advanced economies. You can see where China's making investments for soft power. So we're looking in that lens. We'd look at Africa and South America for soft power investments. But also you can see they're extending their economic reach into the modern world with investments in Europe, the U.S., North America. We'll be taking a look at some of the leading sectors historically for Chinese FDI. So extractive investments in energy, power, metals, more along the lines of soft power and other investments when you look at real estate, constructing dams, constructing roads, transportation, often in growing economies or other emerging economies around the world. Regardless what kind of M&A investment or partner that you're working with, it's good to know who you're working with. Chinese investments are coming from both the state sector and the private sector. One thing in working with state-owned enterprises is that all of them virtually have a very robust network of subsidiaries and companies that are sort of underneath that state-owned company's umbrella. So tracking ownership of Chinese companies is often quite a challenge. But if you're working on an M&A deal with a prospective partner, it's a good idea to know whether you're working with a state-owned enterprise or not. The private sector investments represent a range of investors. So there's companies and corporations like Lenovo and others that you're probably familiar with, as well as a lot of private equity and EB5 investors. I'll assume for this presentation that everyone is familiar with EB5, but if you're not, it's easy enough to understand that category of investors just with a Google search or other research. Appropriately enough, the U.S. and other Western governments are, like I say, appropriately concerned when a Chinese company wants to invest into a company within their home region in terms of whether or not there's any security issues and whether or not that Chinese company is tied to the Chinese government or not. And those are very appropriate concerns. But if you pay only attention to the media and the political chatter, you may think that all Chinese companies are tied to the state sector. And that's simply a mistake to think that. It's not true. Chinese GDP in general terms is about 70% private. 70% private, and only 30% would be driven by the state. It is true that the state kind of controls the commanding heights of the economy, but a bulk of what goes on in China is driven by the private sector these days. So there we see the WH Group. They made last year, latter part of the year, they made the largest investment ever of a Chinese company into the U.S. when WH Group bought Smithfield, and that's a pork producer. Got a lot of scrutiny in the U.S., drove a lot of headlines, but obviously pork and meat are not national security concerns. Geely, they recently bought Volvo, and Geely is a private company, and just this year, Fisker, an electronic car maker, was bought by Wansing. So another another automotive buy in that sector just this year, Volvo a few years ago. You're probably familiar with Lenovo when they bought IBM's personal computer business. Well, just in the first quarter of this year, they also purchased IBM's 886, which is an Intel-based server business, and Motorola Mobility, a significant chunk of Motorola. We'll see some of the traditional investments that China makes in the West and in the U.S., and where a significant amount of capital flows have gone into segments. So traditional sectors, financial services, energy, real estate, so not the extractive resources, but the traditional base is here. And as we talk further in the presentation, we'll see how that mix is changing. So in terms of the overall trend, the uptick, mirrors the global trend with not much investment coming in prior to 2008. Last year, $63.6 billion in investment into the U.S. and a breakout year, a new high water mark anticipated for 2014. Already in the first quarter of this year, for example, $6 billion worth of FDI has gone into technology sector alone in the U.S. And that investment in technology represents a global trend, whereas over the last 5 years or so, advanced economies, looking at the advanced economies, China's capital has begun to increasingly target technology and innovation-intensive industries. So currently, the mix is a lot more heterogeneous than what you might traditionally think of as Chinese investments. A lot of people think automatically of resources, but actually a lot of investment is going into, as China looks for more to climb up the value chain for its companies and also looks to become more of a global competitor. They're investing in technology and innovation type businesses. So you're seeing software, IT, even medical devices, aerospace, pharmaceutical, and biotech investments. Now let's take a look inside China at the business landscape there. And that's both for focusing on folks that may be listening that are going to focus on that market, and also to get a better understanding of the environment that's shaping the Chinese companies as they're coming out of China. So the Chinese Communist Party, their main goal is to stay in power, as a lot of autocratic governments will want to do. But they're doing that by growing the economy and maintaining stability. It's interesting sometimes to look at China's foreign policy, and you'll notice that objective is even played out there. So a lot of times when China makes a foreign policy decision, you can track that back to them making that decision based on wanting to grow their economy and maintain stability. There's been a new group of Chinese leaders that came on stream about a year ago, and they'll be there for the next for a 10-year term. New leaders, same priority. Changing within China is that the Chinese people are changing. As China's become more global, experience the world outside of China and outside of the Chinese education system. As you get richer, as your GDP grows, as your worldview expands, all of a sudden those people have increasingly very different expectations of their country and of their government. And it has begun to reform its system of government. And the hallmark of that is the Chinese government is exponentially more responsive to the people today than they've ever been. Which isn't to say that it's becoming a democracy, and it also isn't to excuse any of China's authoritarian or human rights violations. But it is accurate to make the observation that the government has never been as responsive to the people as they have been today. For example, no one in the world, government or company or anywhere, tracks popular sentiment or does as much polling as the Chinese government does. And a couple of ramifications of that. The current crackdown on corruption very much reflects what the people want them to do, and appears to be much less focused on the government officials sort of settling political scores amongst themselves, and focused on actually addressing serious corruption issues within China. And then more practically, on a day-to-day basis, the Chinese government officials that are, or Communist Party officials that are working in provinces, villages, townships, that are overseeing entire provinces, they're much more focused today on solving problems and working out disputes by understanding what the popular sentiment is, than just in the old days where you might envision them kind of ruling by fiat or ruling simply sort of by the rule of the iron fist. That's really not true today. Chinese government officials are working hand in hand on local levels and provincial levels to understand the people's will much more than they ever did in the past. So we're seeing now a leadership that is faced with change. And in order to stay in power and to maintain stability, we talked that they need to reposition the government. And at the same time, they're being forced to, by economic situations, to rebalance the economy, to take on the huge gargantuan task of rebalancing and repositioning the Chinese economy. The gist there, what's going on there, is that it's obvious to economists and to officials that the Chinese economy can no longer grow in a meaningful way based on the old model. And that old model is inbound foreign investment and cheap imports. That model served China in the world in many ways extremely well by creating incredible growth. But within that growth, it also created serious imbalances within the Chinese economy. And those imbalances can no longer sustain growth. So obviously, when we talk about the Chinese government or we talk about the Chinese economy, those can be the subject of extensive webinars just by themselves. But let's move forward and focus on what we want to talk about. So, that situation where there's imbalances within the Chinese government, Chinese economy, that's forcing a rebalancing, what they're driving it towards more of a consumer-based economy, to create more like the West in a more consumer-based way. So consumerism and moving populations of people off the land. China's in the process of taking 250 people off the land and moving them into urban settings. That's creating Manhattan's worth of new consumers every year in China. So obviously the service sector is creating jobs and growth, and it's a consumption-based economy these days. So notably, as this new society emerges, it's driving its own characteristic consumer trends. And because of the size of China, those consumer trends are beginning to affect the rest of the world in terms of buying habits, trends, preferences, and things like that. And if you're looking at this slide, the woman and the baby there, when that woman was that baby's age, China would have been in poverty, and there would have been mass starvation going on during her time during the Cultural Revolution. And you can see in that picture there, she was standing in front of a well-stocked store. So those huge shifts in what's happening between one generation and the next, creating consumers and creating a new generation of people with desires and ambitions, changing the economy and also changing how the government needs to work with its people. So now let's take a look at some of the growth opportunities in China. The American Chamber of Commerce has just released its annual business climate survey, and according to its members, a fairly optimistic outlook on China. 70% of companies in China are optimistic to slightly optimistic about the business environment there. Sectors for growth and opportunity for Western companies, anything to do with urbanization. In addition, China is revamping its healthcare system, so there's a lot of opportunities with medical devices, hospitals, what would you call it? Electronic ways of managing healthcare databases and things like that. Anything related to healthcare. The environment is a major issue, obviously, in China, so that includes not only energy, clean energy, but also cleaning up the environment and the pollution. A lot of opportunities there. Agriculture, as all those farmers that did a lot of handwork and a lot of low-tech farming move into cities, there's opportunities there for creating higher-tech farming that would require fewer farmers and produce more food. But also food safety and other issues that relate to agriculture. And then services. One thing about the West and the US is, we're great at services, and China is rebalancing and moving towards a service-based economy. So a lot of opportunities there as well. China is and will continue to be a challenging place to do business. And overarching risks within the China model include the Chinese economic slowdown. Obviously, the economy was growing at over 10%, and now it's going to grow at 7.5% or so. If you're in the consumer sector, you're not going to be impacted by that so much. But if you're in other sectors, you will be impacted by the slowdown, steel or other things like that. Labor costs and shortages. China has a lot of people, obviously, but they tend to be relatively thin in having expertise in any one particular area. And in terms of labor costs have been rising in China as the government repositions the labor force in order to be more high value and less in terms of producing cheap goods. Protectionism is always going to continue, or will continue to be an issue, at least for now in China. A lot of advocacy by the U.S. government and the U.S. Chamber of Commerce and other organizations to try to even the playing field. But whenever you've got a situation, as you do in China, where the government is part of the economy in the state sector, you're going to have a certain amount of protectionism. And you've also got rule of law issues in different provinces that also lead to, you can add into that cybersecurity. So those are the overarching terms in China, what some of the challenges are. So I talked a little bit about the labor shortage and labor costs. It's not difficult nowadays to find a Chinese national to run a company in China or to be a CEO. A lot of bright people, a lot of increasingly experienced business expertise there. The challenge is finding someone to run your factory or someone to be those middle management positions. Inconsistent regulatory interpretation and unclear laws continues to be an issue in China, where laws are either written very vaguely so they can be interpreted by government officials kind of as they please. And then also with the size of China and the number of provinces, sometimes those laws are applied unevenly in different provinces. Licensing has become an increasingly troublesome issue for foreign companies in China. A lot of the licensing laws that are on the books favor Chinese companies. And then also that situation that I just described, where different laws are applied differently in different provinces, is also a challenge. So if you're looking to increase your factories and you want to build one in province A, there may be a certain licensing regime that you follow, and then you follow that, and then now you're going to go to province B. Well, it's a different regime, so that means you have to bulk up and follow that process. In addition, similar to the protectionist or market access issue, there are licensing laws that are on the books that favor Chinese companies over foreign companies. In the MCM China survey, they asked their members about mergers and acquisitions, and what they asked was, in the last 2 years, what are the biggest obstacles to pursuing M&A transactions in China? And the number one, 73% of the answers related to difficulty in obtaining credible data. So that due diligence issues and being able to track ownerships of companies, or being able to accurately identify how much stock a company, how much raw materials or what's in the warehouse of companies. So obtaining credible data continues to be an issue in China. Some of these issues will overlap a bit. So approval from multiple agencies, sometimes the course of legal approvals for mergers and acquisitions are not clear and you end up between agencies. Legal due process. Within the AmCham China survey, it showed that the rule of law and due process continues to improve in China, but it also continues to be not perfect, so it continues to be a problem. And then other aspects of procedural transparency continue to complicate the M&A picture in China, although every year there are a lot of significant M&As there. And as companies gain experience in China, they're often more adept at navigating the waters there. So looking at how China views the West, Western markets, typically look as foreign to Chinese investors as the Chinese market appears to Westerners. Remember, it's not the market or the country that's foreign; it's the traveler that's foreign. So they are sometimes as baffled by our systems and markets as we are of theirs. One perception that's dogging the U.S. in particular, though, is the idea in many Chinese investors' minds is that the U.S. market is closed to Chinese investors. So even though we see sort of a 45-degree angle, in terms of the amount of investment from China coming into the U.S., there continues to be the perception that the market is not receptive or open to Chinese investment, and that continues to be based partly on the media in China, but probably predominantly on a few transactions from the past that fell apart. So the CNOOC transaction, for example, continues to drive perceptions in China that the U.S. isn't open. Chinese see the West as a difficult place to succeed. They see it as high cost. And also see it as a sophisticated market, but it's very complicated. One thing, it's not unusual for Western business people talking to Chinese business people, and some of you may have experienced this, or maybe some of you will in the future. It's not unusual to find the Chinese business folks may have a very low confidence of the success that China may have in the future. So it's not unusual at all for foreigners in a conversation to sort of be when talking about China. It's anecdotal, but there's a lot of consensus around this. So, for example, foreign economic professors may have to argue very hard in order to convince their brightest and most elite Chinese students that not to turn their backs on China. So China has many educated Chinese and many business people in China are concerned about China's trajectory, whereas the U.S. may be bullish. They may be kind of concerned about it. That may be part of the mindset when you're working with Chinese investors. They may, their view of China may unexpectedly be different than what you think it might be. So when China looks at the West, this is from the Rhodium Group, looking at technology deals in the U.S., but it's also the same for a lot of other reasons in identifying the reasons why the West is attractive to Chinese investors. So they're market seeking. These are companies that are already doing well in China and could well stay within the Chinese market and be very successful, but they're looking for more revenue, or they're looking to be the dominant player globally in their sector. Chinese companies are seeking, are strategic assets seeking more and more. So they're looking outside of China to leverage brands, to leverage technologies. They're also efficiency seeking at a higher level. So Chinese companies are becoming more sophisticated in managing their global supply chains. And also, they're looking to manage talent acquisition. This is a study from the Pew Research Foundation that is also mimicked in later studies and in other studies. Basically, China holds the West in high esteem, but the favorability ratings are going down. This is for the U.S., but it also pertains to other Western countries as well. The good news, or the one caveat, is that most Chinese and Chinese business people, when they think about the West, or especially when they think about Europe, they do see distinct differences between countries. So they see, France as being its own entity, and Germany having its own relationship with China, or having its own favorability rating. Whereas, as you may be familiar, a lot of Westerners, when they look at the East, tend to sort of lump China in with Japan or see Singapore as being not that much different from Malaysia. Chinese don't look at it that way. They look at France as being France and the UK as being the UK. The other caveat to these favorability issues is that consistently the younger generation tends to be more favorable than the older generations. And it certainly is, you can anticipate that it would be true when you meet eyeball to eyeball with Chinese business people. You can expect them to give you genuine respect and to be positively disposed to people from foreign countries, even if they're kind of skeptical about what our governments might be up to. The bad news is perhaps will be that these favorability ratings will continue to sink. The Snowden affair in the U.S. and the NSA with security issues, the weighing into the island and the territory disputes that China is having drives favorability ratings down, and also possibly the Russian situation with the Ukraine and the U.S. election cycle that's coming up suggests that these favorability ratings, national favorability ratings, aren't going to change much on the upside anytime soon. So some more data. This is from the international consultancy APCO, and they did a survey with a Chinese newspaper in Beijing and in the US, China Daily. So APCO China Daily survey. And they talked to Chinese companies that were in the US and asked them whether those companies felt that they faced similar challenges in the US as other foreign firms were facing. So a bit of a nationalism kind of question, but the results are kind of stark. So if you work with Chinese companies, they may feel a bit like the U.S.'s and Western economies provide a greater challenge to them, a steeper slope than other foreign companies. So 18% felt that it was much harder, a lot harder for Chinese companies. 39% thought it was at least somewhat more difficult, and only 41% thought it was about the same, and almost nobody thought that it was easier for a Chinese company in a Western environment. That same survey also asked for some hindsight observations. In other words, they asked the Chinese companies that were already in the U.S. what advice would they give to a Chinese firm coming in. A couple of the answers suggested that the companies on the way in didn't fully appreciate the complexity of a Western market. So their advice was to hire and work with local experts, so that's good for consultants. Thoroughly study and understand the Western market, the U.S. market that you're going into, and also really appreciate the cultural differences. As you may be familiar, regulations and the regulatory environment within China that these companies might be used to is a little bit more fungible, and regulations can be more easily or reasonably ignored by local Chinese companies than they can be in the U.S. So the advice of companies that were in the Western markets to their brethren on the way in is to really understand and appreciate the regulatory environment. As with many foreign investments, U.S. going into China or China coming into the U.S., be patient and invest for the long term. That's borne out in the AmCham China surveys too. When AmCham China looks at its membership, for example, you'll see survey after survey, year after year, that those that are in country are more profitable and are better at functioning within the country than those newer arrivals are. So having the mindset to invest for the long term is important. And then finally, paying for quality or paying for value has not traditionally been part of the Chinese economy. But obviously it is in the West. Westerners will pay a little bit more for quality. And so being able to explain that to a Chinese company on the way in is very important, because that's a significant cultural difference. So different cultures, different mindsets. So some of the differences are the role of hierarchy. So within a Chinese company, who talks to who is very important. So you would never want to send, for example, a more junior level person over to talk to the Chinese CEO. In addition, in terms of hierarchy, so relaying bad news or relaying problems is not as direct as in the West. So you really want to establish a good relationship with the top of the Chinese food chain within the company that you're working with, and be able to have a good communication there. Other things that are different is the communication style. Relationships in China take time to build. Often in the West, we'll want to have a meeting or two, make a deal, get a proposal on the table, kind of get the deal going. The communication style is longer and is based more on relationship building. Because of the subtleties in communication style and in who says what at meetings and sort of how meetings progress, it's often not a good idea for an American or for a Westerner to go alone to a meeting with a potential Chinese customer. You'll probably want to, if you can. I know travel costs are expensive, and some organizations are kind of thin in terms of how they staff. But it's best if you can bring someone with you so that while you're talking, someone else is watching the room, or while other people are talking, while your Chinese partners are talking, and you're listening to what they're saying, someone else is paying attention to who's saying what and sort of what the order of communications are. Don't be afraid to ask your Chinese partners questions in terms of, how they came to the conclusions that they come to, or being very, focused and aggressive in your asking questions, trying to clarify things. That's appreciated in China. You won't insult them. Decision-making style tends to be more top-down in China. So if you run, so for example, if a deal or if a negotiation runs into problems, negotiating with the middle part of the Chinese government may not be as effective as going right to the top, because those middle people are relaying, in transients or kind of slowing down negotiations. May just be mimicking what they're hearing from at the top. And if you continue to talk to them, it's much better to go back up to the top to find out what's going on. So Chinese companies, are open to hiring consultants and to seeking advice in many sectors. Unfortunately for people like me on the communications side, communications is kind of not a well-established discipline in China, so they tend not to pay for international consulting firms or for brand advice, but they do look to advice on things like M&A, financial services, legal and regulatory. In those areas, you'll want to really walk them through your fees and help them to understand, what the value is in the advice that you're providing. And also, since the Western environment is going to be kind of uncharted waters for them, be sure to go slow and make sure that your Chinese partner understands exactly sort of the environment and the reasons why you're doing what you're doing, and providing the suggestions and the advice that you're suggesting. HR is a consultancy service that they will pay for, especially with larger organizations. China has a well-deserved reputation for being difficult negotiators, and particularly within China, to going back on contracts and continue to negotiate a contract even after it's been signed. The rule of law in the West mollifies that a bit, but nonetheless, negotiating styles are appreciably different. And what you may be perceiving as yellow or red flags during the course of a negotiation may actually just be par for the course. So for example, negotiations typically take longer when you're working with a Chinese partner. You may need to repeat steps in the negotiation. And so, in meeting number 3, you may find yourself going back over territory that you thought was covered and done with in meeting 1. Again, the regulatory environment is different from in the West, so when you work with Chinese investors, you'll want to explain the importance of the regulations and the regulatory environment and the seriousness of complying with Western laws and Western regulations. You want to build up with local governments. You want to build up some equity by meeting with local governments. There may be concerns in the press, or maybe just general concerns within the local government of having a Chinese owner in the neighborhood. So don't hesitate to reach out to local governments and build up some equity there. There's also differences in the media. Your Chinese partner may think that they can control the media in the West the way that they can pay off for coverage or control Chinese reporters, and that's obviously simply not true. So having a professional come in to explain the media environment, doing media training with your Chinese partners, and also having a Western spokesperson to handle the media are all good ideas. having a good employee manual, a really solid, detailed manual is a good idea and can head off problems down the road. Also, getting employees involved in the new company as early as possible is also a good idea. You may need to walk through with your Chinese partners and explain um, in some sectors or in some industrial sectors or maybe just in some areas of the country, the importance of competing for talent and the value of retaining top people. There's a lot more turnover. It tends to be a lot more turnover in China in a lot of cases, but in the West, obviously you want to hang on to those top employees, and in extremely competitive environments, you really want to understand that you don't want to lose your best people. And sometimes that requires a little bit of work with your Chinese partner. Now, the final point is regarding the fact that wealth and money is on a different type of a pedestal in China than it is in the West. So your Chinese partner may expect more deference with their position and based on their personal wealth than they would be used to getting in the West. So you want to be sensitive to that. And also, as we touched on before, Chinese consumers and Chinese companies don't always understand the idea of that consumers will pay for quality and the importance of kind of staying in sync with consumer expectations on quality. Cheaper, there is the mindset that persists in China. It's changing, but there's a strong mindset that cheaper is better regardless of what a little bit more investment in a product might bring. So those are things that you might want to walk through with your Chinese customers or your Chinese partners. So that brings me to the end of the prepared comments that I have. I think we started a little bit late, but I see that we're pretty close to the hour. But there's time for maybe a couple of questions.
Thank you very much, Matthew. Really appreciate you going through the very insightful information on this presentation. I do have a couple questions for you. You'd mentioned the idea of, or actually talking about the United States and Europe. Could you explain some differences between trends with foreign investment of the Chinese between the United States and Europe?
Sure. For example, they're similar in terms of where they're both advanced economies, but on the European continent, China's not investing evenly sort of into all countries. Germany tends to lead the pack recently, at least in 2012. Foreign direct investment, 38% went to Germany, 22% to the UK. 35% to the rest, and only 5% to France. Germany is kind of in a honeymoon period with China in terms of investment, and one of the things is that the Chinese really have a deep respect for German engineering and German thoroughness.
Very, very interesting, very interesting. And another question too, what comes up a lot is uh, individuals or organizations, when they invest in China, they appear to have a relatively easy time getting the money to China. But when money is made within China, repatriation of that money can be difficult. What have you seen on that? And do you have any insights there?
Yeah, there had been some moves to make it easier to repatriate the money, but that continues to be a challenge. Depending on what your business plan is, a lot of companies, because they're in China for the China market. In a lot of cases, people assume that companies are in China, or continue to assume that companies are only in China for the cheap manufacturing. But actually, again, looking at surveys from the U.S.-China Business Council, the American Chamber of Commerce, the Shanghai Chamber of Commerce, increasingly and overwhelmingly now, companies are in China for the China market. So repatriation is important, but they're also investing in the China market to be closer to their customers.
And also regarding Chinese investment outside of China, what is the outlook there for the Chinese government and such for foreign investment outside of China or to outside of China?
Yeah, the government is extremely supportive of that for a number of reasons. One is to continue to grow the Chinese economy, and also to create more wealth and more a greater integration between China and the rest of the world. So the government is pro foreign investment, and that investment is driving some of the changes that you see within China's foreign policy and in even the military. So, for example, if you go back in Western history, the British Navy, the American naval forces, and looking at the military side, the American naval forces and American presence in the world, tended to follow their business interests. So as Western economies engaged in other geographies around the world, they needed to up their military presence in order to protect their investments there and their people there. There's a debate going on in China today uh, regarding the role of the Chinese military and how much to ramp that up. We see the headlines of it ramping up. And part of the reason for that is the arguments going on sort of within the Chinese government in order to protect China's interests around the world. And that's not much different than how the West handles that.
All right. Well, very good, very good. And to wrap things up, you've got some great experience working hands-on in China, and also from the Chinese perspective here in the United States. And I know that we've got other questions that we would like to ask of you. If someone on this call would like to reach out to you and address some more questions that they may have, how would they reach you?
Yeah, email is great. My email is Matt, M-A-T-T, dot Wisla, W-I-S-L-A. So M-A-T-T dot W-I-S-L-A, just at yahoo.com. And I look forward to hearing from anyone.
All right. Well, thank you very much, Matthew, for again the great review, and thank you all for joining us as well in this series of Global PMI Partners webinars. That ends our webinar for today, and thank you very much all for joining.
Thanks, everyone. I really enjoyed it.
All right. Take care, everybody.
Bye-bye.